Thanks for joining us. Today I'm going to address a question that I'm really getting from most of my clients, and that is, has the market peaked? Before I dive into it, the truth of the matter is that no one can time the market. The economy is on strong footing, and recessions are a product of excesses, not necessarily time. However, 9 years is a long time for an economic recovery. No matter your personal outlook, it is prudent to be proactive now and get ahead of the game. Take key steps before your portfolio is subject to the unnecessary losses that can compromise your retirement goals. Through the end of 2017, the S&P 500 has returned a staggering 295% since March of 2009. Throw in dividends, and that return is over 330%. Economic fundamentals have clearly improved. Corporate tax reform should boost profits, and there's no doubt that that has the potential to keep this run going. But future returns are predicated on current valuations. The market does look fully valued. Throw in the fact that while improving, the US economy is still growing below long-term averages. That should have you questioning if such a staggering return is sustainable. Remember, volatility is not a bad thing. Ups and downs are part of investing, and lower future returns can still be positive returns. It just means you need to prepare. It's not time to abandon stocks, simply to readjust and take proactive measures to remove unnecessary risk. Here's the challenge facing today's investors. The average 62-year-old needs to have saved 29 times their annual expense needs to confidently retire. Why is that? Because you need to combat the impacts of inflation, rising longevity, and lower sources of guaranteed retirement income, such as pensions or even Social Security. That can be a daunting number, and the truth is that selling all of your investments to sit in cash is not going to get you there. Neither is moving everything into CDs or other low-risk fixed income investments, especially in this world of low interest rates. What I'm going to show you is 6 steps that you can take now to protect your assets. Remember, preventing losses are important, but not having enough growth in today's world is an equally important risk that can lead to you outliving your assets. Losses are part of investing, but I'm going to show you how to minimize the magnitude of those losses, smooth the ride, and ultimately maximize retirement sustainability. So let's get to step number 1. It's not time to abandon stocks, but just simply reposition and dial back the risk. Timing the market is a fool's errand. Many investors give in to fear and buy and sell at the wrong times. For the 20-year period ending in 2016, the S&P 500 had a total return of 8.18%. However, if you try to time the market and happen to not be invested on the single 10 best days over that period, your return fell to 4.49%. If you miss the top 20 days, that return falls to 2.05%. As investors, we often get emotional and sell after a bad day in the market. Why is that a problem? Because 6 of the 10 best days occurred within 2 weeks of the 10 worst days in the market. The consequence of getting emotional and trying to time the market can be devastating. According to a study by Dalbar, which tracks mutual fund inflows and outflows, the average retail investor for the 20-year period ending in 2015 had a 2.1% annualized return. That's barely keeping up with today's inflation, and certainly not providing enough growth to solve today's retirement challenges. In comparison, a 60-40 professionally managed portfolio returned 7.2%. You need to dial down your return expectations from that 7.2% number going forward, but the point is clear. Investors need to tune out the noise and make prudent decisions that are not determined by fear. Discipline is key, but that doesn't mean you shouldn't take prudent steps to reposition your assets in the wake of current fundamentals. Just don't take extremes. For our clients, we have been repositioning our stock exposure towards dividend growth-oriented securities. These are companies that pay a dividend and have a history of growing that dividend over time. In our opinion, there are embedded quality characteristic advantages to companies that have a history of growing their dividend. They have management teams that are more efficient with their projects, ultimately creating more stable growth, while at the same time rewarding shareholders with tangible income. As you can see, during periods of market stress, like the 1970s or 2000s, dividend payments help reduce the magnitude of potential losses. Furthermore, given this low interest rate environment, dividend growth securities offer both income and a potential to participate in capital appreciation. This helps combat inflation. This is the performance of the Dividend Aristocrat Index versus the S&P 500 for the 25-year period ending in 2017. Over that time, the S&P 500 had an annualized return of 9.7%. In comparison, the Dividend Aristocrat Index returned 11.5%. Now, that may not seem like a lot, but if you were to have invested $100,000 25 years ago, that's the difference between having $1.5 million or $1 million. Now, the magnitude of this outperformance probably is not sustainable, but the fundamental characteristics of dividend growth securities help solve the dilemma between maintaining exposure to growth-oriented assets while also reducing potential risk. Step number 2 is reviewing your fixed income exposure, otherwise known as your bond exposure. There is a common misconception out there that you can't lose money in bonds. Fixed income should represent stability in your portfolio by generating stable, predictable income, a complement to your more volatile, growth-oriented assets that help combat inflation. But there are two primary risks that can cause you to lose money in bonds. The first risk is credit exposure. Many investors own mutual funds that might say strategic income or tactical income or multi-asset class income. The goal of these funds is to maximize income, and they can be especially appealing in this low interest rate environment. They can be great investments, and whether you own them or not, there's a fundamental truth to be learned. For many of these funds, over 50% of what they own might actually be comprised of assets with equity-like risk. For example, they might own stocks, preferred stocks, or junk bonds. So why is that a big deal? Look at what happened to high-yield corporate bonds, otherwise known as junk bonds, during the financial crisis. They were down 22.8%. In comparison, the investment-grade bond market was up over 8.5% over that time. There's nothing wrong with owning these assets. In fact, they should be part of a portfolio. But just understand the risk, and more importantly, understand what you actually own. If you think these assets represent the low risk part of your portfolio, you might unknowingly have much more risk than you think. The second risk in fixed income management is interest rate risk. Bond values fall when interest rates rise, and the Federal Reserve is committed to increasing interest rates. As inflation creeps up, there is a concern that the Federal Reserve could increase rates even faster. Look at what happens to a 30-year Treasury bond if interest rates were to increase 1%. The total loss of that bond could exceed 15%. If you hold a bond to maturity, then that's only a paper loss. But most investors own their exposure through a fund. If you have to sell that fund to take the necessary distributions to cover your expenses in retirement, that's a real loss and a big risk when this is considered to be your safe investment. The good news is that you can control your interest rate risk through duration management. In its simplest form, it just means that shorter maturity bonds have less interest rate risk than longer maturity bonds. Duration helps you measure the extent of that risk. Bond mutual funds list duration, and by emphasizing a shorter duration in a rising interest rate environment, you can control and reduce that risk. Step number 3 is incorporating alternative assets. What is an alternative asset? Well, it's an asset where its performance should be non-correlated or independent to that of traditional assets like stocks or bonds. Alternatives have been out of favor over the last 9 years because why hedge your bets during a bull market? What we have here is the 15-year performance through 2016 of a portfolio of global stocks and US bonds versus one that includes alternatives. As you can see, the portfolio with alternatives had a higher return with less risk. Why is that? Well, one of the alternative strategies in this analysis is managed futures, which is a momentum-based alternative. Look at its performance in 2008. It was actually up 23% when the stock market was down 37%. That's the purpose of alternatives. They move in a different direction as stocks and bonds. So when you blend all these assets together, you improve your returns per comparable level of risk. Another characteristic of alternative assets is that they can actually generate positive returns in times of increased market volatility. The fundamental strategy of alternative investing is long short. Imagine you are a portfolio manager that invests in the S&P 500. You rank the stocks from 1 to 500 based on quality and value characteristics. A long short manager may short the lowest ranked stocks by borrowing them from a broker, then selling them right away. He then takes the proceeds to buy or go long the stocks that were ranked highest. After a certain amount of time, the manager has to repay the shares borrowed. But he is not repaying cash, he's repaying the actual shares. If the longs outperform the shorts, positive returns are generated without actually being exposed to the market. Many of the other alternative strategies listed are just different versions of long short. Managed futures, for example, uses momentum instead of value for the ranking system. And instead of stocks, the manager are doing long short strategies on asset classes like currencies or commodities. In the past, gaining exposure to alternatives was exclusive to high net worth private investors. But now we have mutual funds, which gives the retail investor the ability to access. Step number 4 is to incorporate real assets in your portfolio. Real assets are designed to help combat inflation, more specifically, faster than anticipated inflation. As we get towards the end of this economic cycle, you are starting to see wages pick up and infrastructure spending increase. This leads to more consumer spending and puts greater demand on raw materials, which leads to inflation. Inflation is a big deal because it leads your personal expenses to increase and means that you need to generate higher returns to cover long-term distribution needs. Inflation hedge assets include real estate, commodities, infrastructure assets, precious metals, and Treasury inflation protection bonds, which are Treasury bonds where the principal moves with inflation. Another benefit of real assets is that many of them offer high levels of absolute income. And more importantly, they have the potential to increase those levels of income with inflation. Furthermore, remember our 15-year global portfolio versus one that includes alternatives? Well, the one that included alternatives also includes real assets. They offer the potential for uncorrelated returns and further help improve returns per level of risk. This is especially important to help combat market ups and downs. Step number 5 is to consider principal protected solutions. We are specifically talking about fixed indexed annuities. There is a lot of conflicting information and biases regarding annuities. Some think they are great, others feel they are awful. I'm here to tell you that they are complex and there are no absolutes. I'm going to give you a few basics, but every contract is different. So how do they work? In their simplest form, you pay an upfront amount to an insurance company as an investment. Your return is dependent on some sort of index, such as the S&P 500. You receive a certain percentage of the upside of this index. The percentage is usually capped, and this is called the participation rate. You agree to lock in your investment, typically for a long period of time, perhaps 10 years. In return, the insurance company guarantees that you will not lose money. At the end of the term, you can receive a lump sum or create a fixed income stream for the rest of your life. So what are some of the pros and cons of annuities? Let's start with the cons. One is liquidity. This is a long-term investment where your initial investment is locked for a certain period of time. Typically, after the first couple of years, you can take small withdrawals. But if you exceed limits, there is a penalty. 2, the annuity is a product of an insurance company, and there is credit risk associated with their business model. 3, historically, your upside or participation rate is capped on these products. And 4, if your goal is to create a fixed income stream in the future, that income could be worth less in a rising interest rate environment. But what about the pros? Well, your principal is protected by the insurance company. This is especially important if you think volatility is going to rise. 2, you can gain exposure to most of the major asset classes, including alternatives, without the downside risk. 3, you can be selective and pick the highest credit rated insurance companies. 4, if you decide to take a future income stream, this can help provide a hedge against increased longevity. And finally, there has been an evolution in annuity products. They are creating less volatile indices. Therefore, investors are potentially receiving a much higher participation rate. The combination of higher participation rates and no downside volatility is extremely compelling in this market. Let's review our final step, which is taking these asset class options, evaluating how they can alter your net portfolio risk and return expectations, then stress testing your plan to determine the optimal combination. All of the assets we have discussed today are part of a diversified, optimized portfolio. As an investor, you have the ability to evaluate the potential combinations of each of these assets and use historical analysis to determine the risk-return profile of each option. You can do this by using free software tools such as Morningstar. There is not necessarily one optimal solution for every investor, but what you can do is find the several different portfolio options that are giving you the highest return per comparable level of risk, or the option that provides the lowest level of risk for the required return you need to make your plan work. There are 2 ratios you can focus on to help determine these optimal portfolios. The first is the Sharpe ratio. It determines how much incremental return you are getting for taking on an additional unit of risk. This ratio basically helps determine if you're being adequately compensated for taking risk. The higher the Sharpe, the better. While that's great, some investors are more concerned about reducing the downside potential in a 2008 type scenario. For those preparing for retirement, smoothing out potential returns is crucial in order to not outlive your assets. The historical maximum drawdown shows the amount of a portfolio lost from the peak of the market to the bottom of the market. By using both of these ratios in conjunction, investors can identify the several different portfolio options that are optimal, which they will then use to run their plan. Speaking of your financial plan, the goal for every investor is going to be different. A financial plan is essentially a roadmap. It's going to analyze all of your future cash flow expectations and run multiple scenarios to help determine the probability of successfully completing your goal. It will then determine steps that you need to take in order to maximize the probability of achieving that goal. The Monte Carlo simulation is the quantitative version of this analysis. Using those different optimal portfolio combinations determined by using the Sharpe ratio and maximum drawdown, it will determine what portfolio balances you should expect to have over the course of your retirement years. It will also tell you the probability of achieving your goals, such as the likelihood of not outliving your assets. You can run this analysis with the different optimal portfolio combinations to see which one gives you the highest probability of success. However, when planning for volatility, it's important to take a couple of steps. 1, instead of focusing on ending balances, emphasize the portfolio combination that maximizes the 10th percentile. That's essentially the combination that gives you the best outcome in a worst case scenario. 2, try increasing your projected expenses to see what difference that can make in the plan. For example, inflation looks to be on the rise, so have your expenses increasing faster every year. And 3, dial back your return expectations. Just because the market has historically given investors over 8% doesn't mean that's the case going forward. Stress test your plan to make sure it passes the worst case scenario. So what are your next steps? There really are two choices. One, determine if professional guidance makes sense. Click on the button below for a no obligation call to learn how to incorporate these strategies into a comprehensive retirement plan. Or continue to educate yourself. Enter your email address below to watch our full-length video, The Biggest Concern of Pre-Retirees, a 5-step action plan to help ensure you don't outlive your assets. Being proactive and getting ahead of volatility is key. Thanks for watching today.